Investing in stocks is one of the most common and popular ways to invest one's money. Just a note of clarification, when I say stock market, I'm referring to individual stocks, mutual funds, index funds, and exchange-traded funds, or ETFs. So what is the stock market, and what are stocks? Publicly traded corporations have the ability to sell shares of stock on a public market, or exchange. You can think of stocks as a tiny piece of ownership in the company. The reason a company would sell shares of stock is to raise capital or funds that it can use to grow its business. After a company first offers shares of stock for sale, known as the initial public offering or IPO, shares are sold to the public and subsequently traded, meaning continuously bought and sold, on the market. The stock market refers to any of the exchanges on which shares of stock are sold or publicly traded. This includes the New York Stock Exchange and NASDAQ in the US. Other countries have their own exchanges. As an example, IBM and ExxonMobil are listed on the New York Stock Exchange, while Amazon and Apple are listed on the NASDAQ. The exchange that a stock is listed on is not really important. Once you have a brokerage account to buy and sell shares of stock, you can buy from various exchanges. Stocks have ticker symbols or letter codes. For examples, the letter J and J are for Johnson & Johnson, MMM for 3M, and PG for Procter & Gamble. So if you ever wanted to look up the stock price, you would just type in the stock's ticker symbol. You may also hear the word index, which is basically a collection of stocks used to gauge the general performance of the stock market. Think of the index as a benchmark. The two most popular indexes are the Dow Jones Industrial Average and the S&P 500. You don't have to worry too much about these, but if you hear on the news that the Dow or the S&P are up today, it gives you a general idea that the stock market as a whole is doing well. As I said, a share of stock is basically a small piece of ownership or equity in the company. By purchasing shares of stock in a company, the purchaser is providing the company with capital so it can use it for research and development, new machinery, hiring top talent, or any variety of purposes that it deems necessary to earn more money. If the company succeeds in its goals, the value of the stock will increase as determined by the marketplace. Let's go over an example. Suppose you purchase 10 shares of stock in ABC Company for $50 per share, so you spend a total of $500. Let's say the company comes out with a new product and is doing well. Now a year later, the shares are trading at $60 per share. The more demand there is for a particular stock, the higher the value will be. So now, if you wish, you can sell all 10 of your shares at the current market price for a total of $600, giving you a profit of $100. One of the nice things about having money in stocks is that it is a liquid investment, meaning you can sell off some or all of your shares of stock if you need the cash. I would like to offer one piece of advice. Don't trade on margin. That is, don't buy stocks using borrowed money. Brokerage firms will offer something called margin, which is essentially a loan that they give to you to buy stocks, and they'll charge you interest for that loan. So if you think you have a surefire investment and it turns out to be a flop, you'll not only lose any of your own funds that you put into that investment, but you'll also have to repay the loan back to the brokerage firm. In short, trade with only your own money.